What if I told you that you could be um, dead wrong 70% of the time, like lose 7 out of every 10 trades you take and still build life-changing wealth?
I mean, it sounds completely backwards.
It really does. But today's deep dive is going to hopefully shatter the biggest illusion in finance. We are constantly fed this narrative that high-level trading requires some sort of crystal ball.
Oh, yeah, the whole predicting the future myth.
Exactly. That the pros have cracked the code to predicting everything and are just right all the time.
Hmm.
But whether you are a beginner day trader funding your very first account or, a seasoned pro who's been staring at charts for years, our mission today is laser focused on reality.
Right, the practical side of things,
Yeah. We're looking at how to take a small trading account and actually grow it without exposing yourself to the kind of massive risk that just wipes people out.
which happens way too often.
So to do this, we are unpacking a really comprehensive stack of transcripts from an intensive trading mentorship known as the Inner Circle Trader, or ICT.
Hmm.
And the core premise, the hook that completely blew my mind, is that high accuracy is basically a myth.
It is a massive paradigm shift, honestly. When you really dig into the source material, the most consistent wealth building in the markets has very little to do with predicting the future with absolute certainty.
Right.
True wealth building is about process-oriented thinking. It's about the underlying math of small, consistent gains.
Which is not as flashy as the internet makes it look.
Not at all. It
Yeah.
is absolutely not about treating the market like a lottery ticket and, swinging for the fences every single time you open a position.
Okay, let's unpack this,
Yeah.
because being wrong 70% of the time and still making money feels like it breaks the laws of physics.
It does sound like magic at first.
Right. Before we even look at a single chart or talk about where to enter a trade, we really have to understand this math. The sources are very clear that new traders generally go broke because they're chasing that illusion of the home run trade. But how exactly does losing 7 out of 10 times actually result in a growing account?
Well, it all comes down to the mechanics of the reward to risk ratio, or R to R, as you'll often hear it called.
Okay, R2R.
Yeah. For those who might be new to the concept, your reward to risk ratio is a strict measure of how much you expect to make on a trade compared to the exact amount you are willing to lose.
Got it.
It's essentially the business plan for that specific trade. So if you risk 1% of your total account balance to potentially make 3%, well, that is a 3-to-1 ratio.
Let me make sure I'm following the math on a practical level here. So if I have a $1,000 account, I'm putting $10 on the line to potentially make $30.
That is the exact formula, yes. Now let's apply that to your 30% win rate. Let's say you take a series of 10 trades. You lose 7 of them. At 1% risk per trade, you are down 7% of your account.
Which hurts mentally.
It does. But on the 3 trades you actually win, you hit that 3-to-1 reward. So 3 wins multiplied by 3% equals a 9% gain.
Oh, wow. Okay.
Right, so you subtract your 7% in losses, and you are still walking away with a net profit of 2%.
That is wild. It's like a baseball player batting, what, .300?
Exactly.
You're technically failing most of the time you step up to the plate. You're walking back to the dugout with your head down over and over again. But if every single time you actually connect with the ball, it's a guaranteed home run or at least a bases clearing double.
You're going to be an all-star.
Right. You don't need to hit the ball every time. You just need the hits to count for significantly more than the strikeouts.
That analogy captures the essence perfectly.
Yeah.
And the source material actually provides a fascinating benchmark to keep traders grounded in this reality.
What's the benchmark?
Well, you do not need 100% return in a month to be a phenomenal trader. Making just 6% a month compounded will double your account in a single year.
Just 6%.
Just 6. And achieving that 6%. The mentorship transcripts show it really only requires catching about 20 pips a week, risking just 1.5% on a simple 1-to-1 ratio.
Hold on, before we go any further, what exactly is a pip? I hear that thrown around constantly, but are we talking pennies, fractions of a penny? What is it?
That's a great question. PIP stands for percentage in point. In currency trading, it is the smallest unit of price movement.
Okay.
For most currencies, it's the 4th decimal place. So if the euro moves from, say, 1.1050 to 1.1051, that is 1 pip.
Oh, so we are talking about microscopic movements.
Completely microscopic. Catching 20 of those in a week is an incredibly low hurdle once you know what you're looking for.
But wait, if the math is this forgiving-like, if I can be wrong most of the time, only catch tiny microscopic movements in the market, and still literally double my account in a year? Why do so many traders blow up their accounts?
Yeah, that's the million-dollar question.
Yeah, I mean, why isn't every person with a brokerage app just doing this?
Because human psychology aggressively fights against this kind of slow, methodical math.
Interesting.
It really comes down to greed and impatience.
Hmm.
Traders, especially newer ones, they don't want 6% a month. They want 100% by Friday so they can, post a screenshot on social media.
To flex on the internet, right?
Exactly. And because of that impatience, they use a really destructive strategy like the martingale approach.
Okay, for the non-gamblers listening,
Yeah.
what is the martingale approach?
It is a betting strategy straight from the roulette table. It's where you double your bet after every single loss, assuming that an eventual win will just recover all previous losses plus a little profit.
Which sounds incredibly dangerous.
It's toxic. In trading, it means a trader takes a loss, gets angry, and decides to risk 10 or 20% of their account on the next trade just to make it back instantly. Yeah, they turn a mathematical certainty of long-term probability into an immediate emotional roller coaster. When you have 20% of your net worth on the table, fear completely takes over.
You can't think straight at that point.
No, you close your winning trades way too early because you're terrified the market will take the profit away, and you hold losing trades until your account is empty, just praying the price bounces back.
So the foundation of surviving this game is the math. We absolutely need trades that offer at least a 3-to-1 payout to make this low accuracy model work. And we need the discipline to stick to 1% risk,
That's the bedrock.
which leads us to the next logical step.
Yeah.
How do we actually find those specific setups in the market without using massive stop losses? Because if my stop loss is, say, 50 pips wide, my reward has to be a massive 150 pips just to hit that 3-to-1 ratio.
And those moves do not happen every day.
Right. So how do we fix that?
This is where we get into the actual framing of the trade, starting with what the sources call top-down analysis. The reality is, the big banks, the large institutions, the central algorithms that actually have the sheer volume to move the global market, they aren't making their major multi-million-dollar decisions based on a frantic 5-minute chart.
Makes sense.
They are analyzing the markets on monthly, weekly, and daily timeframes.
And this brings up a key piece of jargon from the sources: institutional order flow.
Yes, exactly.
Basically, the idea that you want to be riding the coattails of these massive banks,
Yeah.
trading in the exact direction they are pushing the market based on those higher time frame levels.
That is the core philosophy. You want to anchor your small day trades to the massive momentum of the institutions.
Let's get specific, though.
Sure. The sources provide a very detailed case study using the Aussie dollar to illustrate this. First, they identify a key level on the daily chart specifically, a daily bullish order block at the 0.7512 price level.
Okay, 0.7512.
That daily level is the anchor. That is where they anticipate the institutional buying algorithm to step in.
Let's pause right there, because order block is another one of those terms that gets thrown around like everyone just inherently knows what it means.
Fair point.
What does an order block actually look like visually on my screen? If I'm staring at a chart right now, what am I looking for?
Visually, a bullish order block is typically the last down close candle, so the last red candle, that occurs right before a massive explosive upward move that breaks previous market highs.
Ah, okay. The last dip before the rip.
Exactly. That specific down candle represents the footprint of the institution. It shows where they accumulated their massive buy positions before launching the price. The theory is that when the price eventually drifts back down to that specific candle's price level, in this case 0.7512, the institutional algorithms will defend that level and buy again.
Here's where it gets really interesting. If I'm a day trader, or I'm just trying to pull a quick 20 pips out of the market today, why on earth do I care about a massive daily order block?
It seems disconnected, I know.
Right. Isn't looking at a daily chart massive overkill for a trade I plan to be in for maybe 2 hours?
It seems like overkill until you look at the mechanism of risk reduction. Intraday charts, like the 1 minute or the 5 minute, are largely just chaotic noise unless they are anchored to the higher time frames where the real volume actually resides.
Okay, how so?
Let's look at how they trade that Aussie dollar example. We have our daily level at 0.7512. If you just buy blindly on the daily chart, the daily price swings are huge. You might need a massive 40 pip stop loss just to keep from getting randomly knocked out of the trade.
Right, and a 40-pip stop means I need 120 pips of profit just to get my 3-to-1 ratio. That could take a week to play out.
Exactly the problem. So the process is to refine the entry. You wait for the price to hit that daily 0.7512 level, but you don't enter yet.
You just watch it.
You watch it, and instead you drop all the way down to a 15-minute or even a 5-minute chart. You zoom in with a microscope to look for your actual entry signal right as the price taps that daily level.
Oh, I see.
In the case study, by zooming into the 5-minute chart, they find a refined entry at 0.7515. And because they are now operating on a micro time frame, their stop loss can be placed just below the recent 5-minute low, which is at 0.7507.
So the risk is reduced to just 8 pips.
Yes. You are trading a massive, highly probable daily institutional level, but you are entering it with a microscopic 8-pip risk.
That is brilliant.
Because the risk is so tiny, the price only has to move 24 pips in your favor to hit that magical 3-to-1 reward ratio. In the sources, this exact setup easily paid out 9-to-1 just by reaching the nearest short-term high.
That is the magic trick right there.
Yeah.
Small, consistent gains become incredibly powerful when your risk is dialed in that tightly.
Precisely.
But of course, the market isn't a charity. It's not just going to hand us these setups on a silver platter. Now that we know we are looking for these institutional levels to get our 3-to-1 ratios, we have to talk about the landmines.
Yes, the traps.
The traps set by what the sources call smart money to specifically hunt and shake retail traders out of these exact positions. Let's do a little mental movie here to understand this.
Okay, paint the picture.
Picture, I'm a beginner retail trader. I'm sitting at my desk, and I see the price of a currency just bouncing between two flat lines all morning. It's just trapped in a box.
What you are describing is a market in consolidation. It is moving sideways in a tight range, and retail traders are generally taught to bracket that consolidation.
Right.
They say, well, I don't know which way it's going to break out, so I'll put a buy order slightly above the box and a sell order slightly below it, and whichever way it explodes, I'll catch the ride.
Right. And by doing that all across the globe, retail traders create what the sources call liquidity pools. They are essentially stacking thousands of orders in the exact same spot just outside that box. Wait, so let me see if I'm picturing this right. If all these retail stop losses and breakout orders are clustered together, are they basically acting like a fuel station? Because if I'm a massive bank, I can't just hit a buy button on my app like a regular person, right?
That is the core mechanism of the market that most people never learn. Trading is a zero-sum matching engine. For every buyer, there must be a seller at that exact microsecond and vice versa.
Right.
If a major bank wants to buy $500 million of a currency, they cannot simply buy it at the current price. There aren't enough sellers offering it.
So what happens if they try?
If they try to force the order through, they will experience massive slippage. They will eat up all the sellers at the current price, then the next price up, and the next, driving the price drastically higher on themselves and totally ruining their own trade.
So they literally need forced sellers to match their massive buy orders.
They absolutely require them. What's fascinating here is what the sources call the market efficiency paradigm. Market makers aren't evil villains sitting in a smoky room trying to ruin your Tuesday.
Though it feels like it sometimes.
Oh, definitely. But they are really just efficiently seeking the necessary liquidity to facilitate their own massive volume without causing slippage. So where is the liquidity? It's sitting below your consolidation box in the form of retail sell stops.
Ah.
Remember, if you bought inside the box, your stop loss is a sell order. If you want to short the breakout, your entry is a sell order.
So the bank intentionally drives the price down to trigger all those retail sell orders.
Yes. In a market that is fundamentally bullish and wants to go higher, the market maker will purposely push the price down first. They break it below that consolidation range in what the sources call a turtle soup setup or a false breakout.
I can picture it. It looks like a crash. The retail trader who bought inside the box hits their stop loss and gets kicked out. The breakout trader sees the drop, gets a huge rush of adrenaline, and jumps in to short the market, thinking it's crashing.
And right into that artificial manufactured selling pressure, the market maker is just standing there with a giant basket, absorbing every single sell order at a discount to fill their $500 million long position.
Wow.
Once their massive orders are filled, the trap snaps shut. They reverse the price, leaving the retail short sellers trapped underwater, and the market violently launches upward toward its true target.
It is ruthless. But once you understand the mechanics of the matching engine, it makes total sense.
Mm.
And the sources point out, this doesn't just happen with sideways consolidations. It happens with classic textbook chart patterns too, like the false flag.
Yes, the retail obsession with chart patterns is highly exploitable. A bull flag looks like a sharp move up. The flagpole, followed by a slight downward diagonal consolidation, which is the flag.
Right, taught in every beginner book.
It is taught in every beginner trading book as a continuation pattern. You're supposed to buy the flag, expecting another explosive move up. But the sources caution that you have to look at the larger context.
The kind of context.
If this bull flag forms when the higher time frame is in a premium or distribution phase, meaning the overall market is actually overbought, exhausted, and institutions are looking to sell, that flag is a trap.
It's essentially bait. It's designed to look like a perfect textbook setup to get retail to blindly buy in, providing the exact liquidity the institutions need to dump their massive positions right before the market drops off a cliff.
Which is why you have to anchor your expectations to the big picture daily chart. You cannot just trade geometric shapes on a 5-minute chart without knowing who is actually in control of the larger trend.
So what does this all mean when you are actually sitting at your desk? The trap hasn't happened yet, and you have to click the button. We have the math of 3-to-1. We have the setups using top-down analysis to get tight 8-pip stops. We know how to dodge the market maker traps by understanding the mechanics of the order book and liquidity.
We have the whole toolkit.
Exactly. Let's get into the trenches of actionable risk management now. Specifically, what do we do when things go wrong? Because the sources have some highly counterintuitive rules, starting with what to do immediately after you take a loss.
This is perhaps the most vital takeaway for protecting your capital and, honestly, your sanity.
I believe it.
The natural human instinct after taking a financial loss is the urge to make it back immediately. That is exactly where revenge trading starts. You take a loss, you feel cheated by the market, and your brain demands justice.
Right, which leads back to that martingale approach you mentioned earlier.
Yes, exactly. But the sources offer a strategy that forcefully breaks that cycle. It is a strict rule. If your standard risk is 2% of your account and you take a full loss on a trade, your next trade must use exactly half that leverage.
Half?
You must drop your risk to 1%.
Wait, cut it in half? That sounds terrible.
Yeah.
If I just lost 2% and I want my account back to its high water mark, having my risk means it'll take twice as long to recover. Why would I willingly cripple my earning power when I'm already in a hole?
Because your primary job as a trader is equity preservation, not revenge. By halving your risk, you instantly remove the emotional pressure cooker. You are acknowledging the loss and prioritizing a clear headspace.
That makes sense.
If you try to double down, you are trading out of fear and anger, which guarantees you will miss the proper setup. But mathematically, halving your risk does not actually take you out of the game.
How so?
Remember our foundational 3-to-1 ratio goal. If you are now risking 1%, you only need to catch a 2R, a simple 2-to-1 reward trade to make back your entire original 2% loss.
Ah, I see.
As the sources point out, finding a 2-to-1 setup is incredibly common if you are just patient. You mitigate the original loss, you get back to break even, and you did it while exposing yourself to less risk, not more. You survive to trade another day.
That is a brilliant psychological hack. It completely short-circuits the emotional spiral of a losing streak.
Oh,
But what about the other side of the coin? What about when things go right?
the fun part.
Right. The sources spend a significant amount of time discussing the concept of scaling out, or taking partial profits. For instance, if I have a trade targeting a 100-pip move, and it hits my 3-to-1 ratio early on at just 30 pips, the strategy dictates taking a portion of the trade off the table immediately.
Pay the trader. That is the mantra repeated throughout the text. If you risk 1% and the trade moves 3-to-1 in your favor, you close out part of your position and bank that 3% gain directly into your equity.
But wait, how does this square with all the prevailing internet wisdom? Because if you go on any trading forum, the gurus say that if you take profits early, you're a coward.
Oh, I've seen those posts.
Right. They preach set and forget and insist you should let your winners run to the final target no matter what. Otherwise, you are ruining your mathematical expectancy. Why does this source insist on taking partials if it supposedly messes up the math?
This raises a critical distinction between textbook theory and actual human reality. The expert in the source material notes that being rigidly dogmatic about profit-taking usually comes from educators who don't actually trade consistently with their own money.
Ouch. But true.
In a spreadsheet, holding to the final target looks great.
Yeah.
In the real world, Watching a trade go deep into profit, stubbornly refusing to take a dime off the table, and then watching a sudden news event reverse the price all the way back to hit your stop loss. That is psychologically devastating.
It's completely soul-crushing. You feel like you had the money in your pocket, you were mentally spending it, and someone reached in and stole it. It ruins your confidence for the rest of the week.
Exactly. Booking partial profits completely removes that psychological burden. Once you bank that initial 3%, the rest of the trade is essentially risk-free.
Right.
You can move your stop loss to break even and just let the remaining portion of your position run toward those higher time frame liquidity pools without a drop of sweat. You don't have to stare at the chart.
So you're playing with house money, basically.
Yes. If the market reverses and comes back to stop you out at break-in, you still made 3%, you paid yourself. If it keeps running to the final target, you are padding your account with a stress-free bonus. Scaling out guarantees those small, consistent gains that actually build wealth over time.
It's all coming together. Let's recap this roadmap for you, the listener, because there is a very clear, actionable path here. First, stop chasing the home runs in the lottery tickets. The secret to growing a small account isn't massive leverage. It's relying on the forgiving math of a 3-to-1 reward ratio.
Absolutely.
Second, you find those tight ratios by anchoring your intraday trades to higher time frame institutional order flow, zooming in from the daily chart to the 5-minute chart to keep your stop losses microscopic. Third, you recognize market maker traps for what they are. They are mechanically hunting retail liquidity to fill their own orders without slippage, so don't leave your stop losses sitting right where everyone else does.
Perfect summary.
And finally, radically protect your capital and your mind. Have your risk after a loss to prevent emotional spirals, and pay yourself by taking partial profits to secure those small, consistent gains.
It is a complete behavioral shift from gambling to operating a professional business, which leaves us with a final thought to consider.
Let's hear it.
If you truly internalize the mechanics we discussed today, the absolute mathematical reality that you can be dead wrong on 7 out of 10 trades and still make 10% a month, a return that would make Wall Street hedge fund managers deeply jealous. How does that change the way you physically feel the next time your stop loss is hit? What if losing is simply the necessary calculated business expense of your inevitable success?